What's going on, everybody? Michael Silva here. You just tuned in to a very special episode because we are going to be going over the stock market indicator that doesn't predict stock market crashes, but it definitely lets us know that the conditions for a stock market crash are very, very real. Not only did it let us know about the February crash, but multiple other ones that we'll be going over in this video. I can't go over this ratio myself, so in order to do so, we're bringing on Michael Gayad for the extended length interview to talk about the lumber to gold ratio. Now, Michael Gayad, he is a portfolio manager at Toroso Investments. He is known for multiple award-winning research papers. He has been interviewed on CNBC, Bloomberg, Fox Business, Real Vision, Wall Street Journal Live, and now on our Figuring Out Money YouTube channel. We're extremely excited to have him on today. So without further ado, let's get into it. Michael, thank you for joining. You're the first person here on the channel that I'm interviewing. So I really appreciate that coming on a Saturday. That does mean quite a bit to our audience. Before we hop into, the lumber to gold ratio and why you find it just so important to use as an economic indicator, how did you first get into this career field?
So, first of all, I hope first is not the worst as you do these going forward. So I kind of have a strange history in the field. So my father worked for Bob Farrell in the late 1980s at Merrill Lynch. And for those that are not familiar with the name, Bob Farrell was known as one of these sort of legendary technical analysts back in the day before you could, with the click of a mouse, overlay moving average and RSI and different technical indicators. And actually for the audience, it's good to kind of go through this exercise. If you look up Farrell's 10 rules on markets, there's a lot of strong wisdom there. But I kind of grew up watching my father in the field. He started his own investment firm in the 90s, got it to about $1 billion in assets, then started up a hedge fund. I joined the family investment firm after I graduated, and was trying to find my way. Right, was still somewhat of an unknown name. My father did very well for himself, but was not somebody who was in the media or kind of put a lot of content from that perspective out there. He passed away in '08. I was not of age to take over the business, and of course, with Lehman, I had no idea what to do with my career and my life. Right? Aside from the personal struggle of what happened then, the family business closing, I didn't know what to do. So. Ended up working for a family office for a short stint, and then joined an investment advisor, and kind of the rest is history. Started really putting a lot of content out there, getting media out there, media exposure. Been a long journey to get to this point, kind of reinventing myself in an industry which is very different than how it was 10 years ago.
You're a CFA, correct?
Yeah, and I got it in 2008, sort of speaking of unusual timing. Getting a CFA in 2008 didn't really help me that much, from a job hunt perspective after the great financial crisis.
How was the process of becoming a CFA? I hear that it's quite difficult.
Yeah, it's rigorous. I mean, it's like anything else in life, right? I mean, you get what you put into it, right? So you've got to really spend the hours. I used a lot of my time when I was traveling, listening to audiobook MP3s of the curriculum, which was as dry as you can imagine. But it did work. I mean, I was very obsessed. I'm very much of the mindset that success equals talent plus obsession plus error, right? So talent is you're good at the field, you can remember things, you can study and apply. Obsession is hours, just straight up time that you're putting into something, and error is luck. The luck component to the CFA curriculum is if you have questions that you don't know the answer to. You can't really get past the pass rate there. So
right.
It's worth it from the perspective of, obviously, it broadens out your knowledge. Very good networking. I'm a big fan of the CFA Institute.
Can you kind of just break down a little bit why intermarket analysis is so important? Just kind of a quick overview. On my daily market briefs, we look at just multiple different things. So we look at the indices, the big ones. We look at commodities. We look at bonds, and we try to piece things together. And various indicators as well. So how is it that you use intermarket analysis to kind of come to your conclusions as where the market might be headed?
Sure. So the book you're referring to was actually a book my father wrote that he published in 1990, and it was a very limited run. But when he passed away, because I was in the media quite a bit, people were bidding up used copies of this book, thinking that it was me who was the author of the book. It was actually my father. Both the same last name. So I got the rights to the book back for $1, and then republished it in his honor, really. And despite it being 30 plus years old, it's still actually very applicable, I think, to markets. Now, anybody that is familiar with the term intermarket analysis, you tend to think of John Murphy, who was sort of kind of pioneered the thinking there on intermarket analysis. And my father had a different spin on it, but the principles of intermarket analysis are that instead of just looking at a chart and saying, here's price, here's history, here's support, here's resistance, it's about really kind of saying, well, what is the chart that I'm looking at and how does it relate to other charts? How does the behavior of one asset class impact another? How does one sector's movement impact another? So a good example and kind of a classic example of intermarket analysis is the relationship of oil to bonds. So now this is going to sound a little strange to some of your audience members, but typically when oil prices rise, you would expect bonds to do poorly, okay? Meaning yields would rise in the bond market. Why? Because oil is a form of cost push inflation, meaning that as oil prices rise, that should increase inflationary pressure in the system. Anybody that's owning bonds then starts demanding more yield, more return, because they have to get after inflation returns. Mm-hmm. So that's how one part of the investment landscape, commodities, in this case oil, impacts bonds. So intermarket analysis is sort of trying to see if there's this information set in some part of the marketplace that another part may not yet recognize that you can maybe take advantage of.
So on your lead lag report, you look at relative strength of just various sectors in the market. And is that really to determine, where we should be putting our money versus kind of like what you state, risk on versus and or risk off?
So a few things. So let's first define the risk on, risk off dynamic, right? Because I'm sure you've seen this a lot in the media as well. If the market's up, they say risk on. If the market's down, they say risk off. That's not what risk on, risk off is. I always use this analogy when I talk about the mutual fund that I run, the ETF, RORO, which we'll kind of briefly talk about. But all I do is try to identify the weather. And risk on, risk off is just a way of saying, here are the conditions that are either pouring outside or sunny for you to slow down or speed up, right? Risk on is about conditions that favor the accident, not the speed up, right? Not sort of going faster on the road. When I was on the road doing CFA chapter presentations, I'd always kind of use this example. When you put an address in your phone, in your GPS, right? Google Maps, whatever it be. You notice no matter how fast you're driving, that ETA just doesn't want to go down. Yeah. You go 20 miles an hour higher, faster than the speed limit. The damn thing just doesn't want to get you there sooner. Right. What is the biggest driver and of variability in your ETA to a destination? It's not how fast you go. It's the traffic. It's how slow, right? The conditions that favor the accident, the risk off, right? The slowdown. So from that mindset, risk on, risk off can be determined using various indicators that tell you the risk is higher for a slowdown. That doesn't, of course, mean that you're guaranteed to crash. It just means you have to slow down in the event that you might. So it's not really about direction, right? Now, as far as the lead lag report and these kind of relative momentum ratios, which I'm a big fan of, the reason that I often emphasize these relationships of sector to the stock market or asset classes to each other is to try to see if the whites of the eyes are showing of some kind of new trend in the marketplace. So, for example, as we speak here, December, there are a number of sort of interesting things that are happening internally within the market. You're seeing financials start to show some signs of life. You're seeing energy materials show signs of life. You're seeing the dollar unrelentingly weak. And you're seeing tech start to maybe, on a relative base, roll over, turn around. That's a pretty big rotational shift from a sector perspective, which I'm sure we'll get into. But the idea is, again, you want to read the teams in terms of not just a stock by itself or a chart by itself, see what the interaction is and how other parts of the marketplace might be confirming within the construct of risk on and risk off.
I think this really leads us into the lumber to gold ratio when we are going to be discussing risk on, risk off. Before we hop into really digging into that, What's your current stance on where we just stand overall right now in the current market conditions?
So I come from the standpoint of somebody who is not just sort of a newsletter research guy, right? I do the lead lag report. I've got a very strong audience there, but I'm a fiduciary, right? As part of Toroso Investments, I run the ATACX Rotation Mutual Fund, which, as of this conversation, is up around 65%. It's in the top, decile of the category. And I also run this ETF RORO, which we launched a couple of weeks ago. So in the midst of the decline during the COVID crash in March, early March, I went risk off. The mutual fund went risk off and positioned all into long duration treasury ETFs and stayed there, avoiding the entire crash. So whatever I have to say, and then went risk on March 31st. So whatever I have to say here, it's not just sort of me hyperbolically making a case for something. I've lived both sides of this. I don't think the conditions are here for a risk off period, at least into the end of the year. And I say that because I think the Fed's going to get its wish. And what I mean by that is the Fed is trying to jam as much inflation into the system as possible. And given that bonds refuse to sort of recognize that, I suspect there's very serious vulnerability in the bond market. Right now, most people, when they trade stocks, they don't think about bonds. But bonds are incredibly important for stock traders because bond yields typically rise when you're in a real risk on period, because it means there's increase in the demand for money. Mm-hmm. Right? Interest rates are nothing more than the cost of capital, which is a reflection of supply and demand. The supply is set by the Fed, the demand is set by everybody else. Right? So if yields are rising, that means demand for money is likely picking up, which is bullish because it means inflation growth expectations are picking up. That's risk on. Those are favorable conditions for risk assets, for stocks, for any individual stock you're maybe thinking about trading. But if that move gets to be too extreme, meaning the cost of capital rises too much and interest rates rise too much in that fervor that inflation expectations rising might be causing, at some point that causes a slowdown because it becomes too extreme in terms of the cost of capital. So I think where we are now, you've got this real reflation trade, I think, heating up in a big way. And I think actually you're starting to see the signs of a rotation out of the darling tech companies, the stay-at-home stocks, everything that has been on fire since the March low, into those areas which everybody, I think, largely left for dead, particularly energy, particularly materials, particularly financials. And I get it, especially when it comes to the energy sector. A lot of people say, well, the writing's on the wall. Alternative energy is going to take over all these big oil companies. You could be right in 10 years. Mm-hmm. It doesn't necessarily mean you're right week to week, month to month, or for the next year. Right? These things take time to play out.
Let's just jump right now into the lumber to gold ratio and how just an average person can use that ratio to kind of determine whether they should be pumping the brakes a little bit and or going a little bit more full throttle in their investing style.
So let's talk about the lumber and gold ratio, and just to provide a little context also around this. So I have on the screen here various white papers that I've co-authored and put out there since 2014 that won different awards over the years. The mutual fund that I run uses utilities and treasury for the risk on, risk off. I have a paper on leverage, which is, I think quite interesting for a lot of active traders. You can view all these papers at ssrn.com, Social Science Research Network. But let's talk about the lumber and gold for a bit as sort of an interesting research study. So when I was on the road, I've been to 47 states. I presented to CFA chapters, CMT chapters all over the country. And of all the presentations I've done, this one on lumber relative to gold always got the most curiosity among audience members. It sounds strange. Why am I looking at lumber to gold as a signal for anything when it comes to the stock market? And it turns out that lumber to gold is actually wildly important to identify conditions that favor an accident in the stock market because of the link to housing. Right? So housing is a leading indicator of the U.S. economy. Most people's wealth are in their homes, not in the stock market. The average home has about 14,000 board feet of lumber. So the argument goes that if housing is a leading indicator of the economy, then lumber is a leading indicator of housing, which means that as lumber goes, there's all kinds of ripple effects in terms of future growth and inflation expectations changing for the economy. Gold, on the other hand, is more of a safe haven risk off play, meaning that when you have these high risk periods in the stock market, gold tends to do comparatively better in that flight to safety type of moment. So the idea is that you compare the two to each other, and lumber to gold tells you something about risk. And one of the slides I'd always show on the road was this one, which looked at the S&P 500's volatility. When lumber outperforms gold, the stock market's volatility is about 13.5%. You don't have to worry about the actual number, just focus on the direction, obviously. When gold outperforms lumber, the S&P's volatility is quite a bit higher. Right? So lumber to gold tells you about gyrations and potential declines, because that's when volatility tends to occur in the stock market. And when you kind of dig down a little bit further, you look at some examples in history. So I used to always kind of show these different slides at the end. So these are examples during major high stress events for the stock market. That top chart is the ratio of lumber to gold. So a rising ratio means lumber is outperforming gold, risk on. Lower volatility likely for the stock market, gold outperforming lumber, risk off. The red line that you see vertically there is when the 13-week rate of change, which is what's below the ratio chart, turns negative, which is the risk off signal in the paper. The third chart there is the S&P right below it. Okay. And that's in 1987. And then the fourth is the VXO VIX-like index, just a play on volatility. You can see that before the 1987 crash, right, lumber to gold turned negative, risk off before it was too late. 1990, same kind of series of charts, right? Ratio of lumber to gold, 13-week rate of change, S&P in 1990, VIX, same deal before the recession, warned you. 2000, VIX spike after. 2001, VIX spike after. 2002, VIX spike after. It's all the same ratio, all the same relationship. But in all cases, risk was managed before it happened, even before Lehman. About 2 to 3 weeks before Lehman, surprisingly, lumber to gold also went risk off. 2011, when everyone's worried about Europe, you say, what does lumber and gold have to tell you about Europe? Turns out a lot, right? Because same deal, it happened right before the Euro crisis that was experienced then. And even this year, the signal, and I mentioned this in the lead lag report, flipped mid-February, right? So ahead of every single major period of market stress, that ratio warns you in advance. Now, there's a couple of things about that. Some people may say, looking at this, well, I guess that means when lumber is weak to gold or absolutely going to crash. No, it means the conditions are there for the crash. Just because it's raining doesn't mean you're guaranteed to crash. Just because it's sunny doesn't mean you won't, right? The conditions are there. The outcome may not be. That's why in the lead lag report and everything I kind of preach about when it comes to markets and risk on, risk off investing, I never advocate shorting. Because the problem is that in this business of investing is that you can be wrong a lot with your risk off signal. And if you're shorting, you lose money one for one because you're inverse to the market. Whereas if you're going into a lower beta part of the stock market, so think things like utilities, healthcare, consumer staples, so things that are still stocks, but not as aggressive on the upside. If you do that, or you go into treasuries, which tend to benefit from risk-off periods, you're much better off because those allow you to be wrong and still make money. And I think this is kind of an important point for your audience. A lot of people get obsessed with signals. The opportunity set can be as important, if not more important, than the signal you're following. How you're executing is really, really critical. Ideally, you want to be able to be wrong in this business and still make money. Right. So that you're not just relying on the signal, you're relying also on the opportunity set to help you out when you're wrong in the signal. The point on the lumber and gold relationship is that it tends to warn you in advance of major high stress periods, which is why it's worth paying attention to. You don't know which signal is the one where there might be a crash. You don't know the mile marker exactly that you might crash your car, but you know you need to slow down. And I think from that perspective, you know, it does bring with this kind of a bigger discussion around how do you really make return? It's not by killing it in the stock market. It's about not getting killed, avoiding a couple of these big declines when they happen, and having a lot of dry powder after it's over.
A question about the lumber to gold ratio. So clearly it has a history of predicting some big events in the market. When you say the 13-week rate of change, is this something that obviously you did your research on and came up with, hey, 13 weeks based off of this, this is why we're using this, so this amount of time versus, 10 weeks or 8 weeks, 5 weeks?
So good question. And this is a part of any back test, right? You always have to define your look back period, under which you're optimizing. So in this case, the 13-week period was chosen because other studies have shown that across all commodities, momentum tends to live in the 3-month time frame. So you convert 3 months into a rolling weekly period that gets you your 13 weeks. It works under shorter time periods, like 3 weeks out all the way to, I think it was around 200, maybe like 210, 220, where there's some predictive power. The choice of the look back period is not sort of as critical as you might think, because over time it tends to get ahead of these declines, irrespective of how short or how fast. There's always this kind of careful dance you have to dance when it comes to any kind of strategy, which is how much do you want to trade on the signal, and how much do you want to give up of signal versus noise, right? So in other words, if you're doing a shorter than 13-week period, you're going to have more trading signals, which means you're also going to be wrong more often than not. You also might be right early, just in the nick of time, more often than not. If you do a longer 13-week, then you're talking about more waves, more cycles. You might be wrong in your risk off. You might be wrong in your risk on. You might be late, but hopefully you're not too late. So you can still capture a decent amount of the avoidance of the crash, right? So it's always hard to know the exact balance of signal and noise based on your look back period, but an important part of any strategy test is to make sure it's not just optimized to one interval. It does work beyond 13 weeks.
Got it. Okay. That makes sense. Where do we currently stand right now with the lumber to gold ratio?
So in the lead lag report, I'll just kind of pull this up real quick here. I publish this every week, and I have a sort of leaders and laggers section, which again outlines the rate with some commentary separate from the signals, their research pieces on the service. But you can tell here the lumber to gold ratio has gone vertical. Now, anybody that happens to be tracking me on Twitter at lead lag report, which thankfully with nearly 200,000 followers, I have people that understand what I do and some people that are just haters. You may recognize that earlier on October, I said, we might be in a juncture here that might favor a crash in the stock market because of this decline that you could see in that lumber to gold ratio collapsing. Shockingly, it just came right back, which is why it is risk on, which is why, by the way, small caps are leading. Small caps have been just unrelentingly on fire. It makes sense. It is. Why does it make sense? It's confirmed play on housing, which is a play on consumer wealth. Well, then small caps, which are more domestically sensitive, should benefit the most from that, right? So it makes sense actually that you would have this relationship where lumber to gold strong and small caps would be strong relative to the broader market. So it's across. That's what I'm saying. Across the board, you have a lot of sort of interesting reflationary trends. Here's small caps against the S&P. Small caps have a long way to go just to get back to where they were on a relative basis. So this still actually, as much as it looks like an extended trend in small caps short term, from a relative outperformance perspective, this is nothing. What we've seen the last couple of months. There's a huge catch-up potential against mega cap, especially against large cap tech, which, if that happens, can result in more risk-on conditions, in the foreseeable future.
Now that you mentioned with small caps, I've been talking about the IWM, just small caps, the Russell 2000, more frequently than usual, just because of its current state on some of the candlestick charts that I look at. So when I look at like the monthly and even the weekly, we're looking at these levels that are very overextended, which I haven't been quite saying, okay, that means that it's going to crash, although sometimes people believe that. What it tells me is it's due to eventually take a little bit of a breath before we get some sort of continuation. And if it doesn't, what I've seen from previous charts and previous just indicators, we can get a very sharp, aggressive move to correct and then continue that momentum towards the upside, more intermediate term. Now,
yeah, no, I don't disagree. And the thing with that is, overbought can stay overbought for a long time.
Yes.
As we know, there's a lot of studies that prove that out. And again, this is a relative argument. So you could conceivably, as much as it seems almost impossible to imagine, you could conceivably have the stock market, have a pretty nasty correction, but small caps be down less in that correction. And by the way, the fact that we're seeing what look like now to be sort of political pressures on tech companies like Facebook, right, with this kind of multi-state lawsuit that the announcement that came out recently. I've been making this case for a while. The politicians are coming for the large cap tech companies. It's only a matter of time. It's a very easy target from a populism perspective. Whether or not they can actually do something about what they claim are monopolies is an open question. But at the margin, it probably does result in a reallocation out of tech into smaller cap names. And then, of course, if you have more stimulus, which is almost a guarantee under the Biden administration, you would think it's probably going to help more directly smaller companies as opposed to these large cap tech companies, which arguably have gotten all the momentum, have been incredible moves, but probably are due for some kind of a pullback more so than everything else. And you can see that, by the way. So here's a ratio of tech to the S&P.
Right.
Yeah, I mean, it's slowly looking like it might try to roll over. I mean, this is obviously since 2019, the tech outperformance is unrelenting. I would not want to touch this kind of a chart personally.
Do you see lumber continuing this move up?
So this kind of goes back to the intermarket relationships, right? So let's go back to what I said earlier, which is that, you get this, the Fed may get its wish, reflation. Commodities are pushing inflation expectations higher. And I even have that chart when you look at inflation expectations. This is sort of a ratio of inflation expectations, basically inflation protected securities against nominal treasuries. So there is serious inflationary pressure building. So yields rise. So that means mortgage rates rise, right? Now, at the beginning stages of that, that's actually positive, because what will happen, I think, is people will start thinking, well, rates are going to start rising now. I better buy that house, right, before rates get higher. So you actually end up kind of having this psychology effect, conceivably, on buying patterns, which increases more housing demand in that fervor initially for fear of missing out on these low rates.
Right. Yeah.
So lumber probably might actually hold, right, broadly speaking. But it goes back to that point that you're kind of alluding to, which is that it could top out. Well, if it tops out, it's probably going to top out with mortgage rates already having risen to some extent, and at some point, as it rises, it becomes an overreaction, which goes back to the bond market overreaction, which takes everything then lower. Right. So this is sort of classic intermarket relationships. How does one area of the marketplace impact another? What I'm making the case on is that commodities, lumber, part of that impacts interest rates. All of the papers that I'm known for, utilities, treasuries, lumber to gold, which are risk on, risk off indicators, they're all about interest rates. There is a natural point where interest rates will get to be too high if that reflation trade does hold. And that's when you get the broader correction across the board and everything.
Right. And when I look at yields, obviously they were smashed down here in March. We had the short term, the 3, the 2, they're basically at 0. The 10 and the 30 have been kind of just since August building up these higher lows and kind of moving up. The 10 years trying to break above 1, but it's not doing so in an aggressive just spike. It's slowly moving lower or higher, and you can see the spreads increasing. And I have a hard time really wrapping my head around the bond market overall. But from my perspective, this kind of drift higher from already a big move to the downside is not necessarily a bad thing. That's pricing in growth and inflation. Would I be correct in assuming that to see that?
Yeah, no, I think that's right. It becomes problematic if you have a spike.
Okay.
Right.
If the drift continues, just keeps on just trucking along and moving, there'll come a time, and we're still relatively low, there'll come a time where obviously it's too high. And then what would the Fed have to do in that case? If inflation starts running too hot, would they be forced to raise interest rates? But if they move interest rates higher in this current environment, we've kind of seen what happens when they do that. Yeah. What do you see happening there?
Yeah, I mean, and I mean, the answer is it depends on where the debt level is at that point, right? Because that's why also there's kind of a natural stopping point on how high rates can go, because with $27+ trillion of U.S. government debt, let alone unfunded liabilities and all the other debt going on globally, interest rates cannot really sustainably rise without making the cost of servicing debt too high. So the Fed probably would have to just pull back on other stimulus and really around the balance sheet and QE 597 or whatever number that we're at this point. But the Fed wants inflation to be hot for a while. That's what I'm saying. This would be really interesting in terms of how this plays out. I know it's, I made the case on March 31st, why the COVID bubble is coming. And you can look this up under Seeking Alpha. And this is at a time when people were saying, there's no way you're out of your mind. The world's collapsing. The world's ending. This was in the height of the COVID fear. The argument I was making then is the same, still applies today, which is that the policymakers are overreacting to the crisis, and it's going to be very hard for them to pull back that stimulus, right? So I don't see how they could pull back stimulus aggressively unless inflation's like 4 or 5%, which again, I would go back to they probably want, because it means debt loads on a real adjusted basis are actually lower. It's either significant inflation or massive defaults. I mean, the Fed and all the policymakers, they're all in the same camp. They're on the same spot, which is that they created this debt monster. They have to find a way to inflate out of it when you can't do it with growth. So you've got to just keep pushing as much stimulus into the system as possible and let it overshoot, because they don't see any other way out of it.
One of the funny tweets that I actually just saw you recently retweet on your Twitter was when you were calling the March bottom, and you're like, all right, you might think I'm crazy, but I'm going to call a bottom here. And then somebody responds with, is this what I pay you for? And then a few months later, you're like, yep. And I wasn't trying to do it from a sort of snarky perspective. Look, the Yogi Berra said it correctly. Predicting is hard, especially about the future. Mm-hmm. I do not believe in forecasting. I was kind of being a little bit, ballsy and saying, I think the low is in, but I was saying that because all the indicators were also suggesting conditions were starting to favor risk on. And I had gotten the risk off side right. Again, the mutual fund went risk off before all this happened, the ATAC rotation mutual fund. And again, everything I do is around risk on, risk off. So when, I've used this line on Twitter before, and I really do think it's applicable. Opportunity always exists when the crowd thinks it knows an unknowable future. Nobody knows what tomorrow brings. Stop with all of the forecasts and all that. Just nobody knows what tomorrow brings. The only thing you can tell is the weather, what's directly in front of you, the conditions that favor the accident. And if everybody thinks they know the future, what does that mean from a betting perspective? Well, if everybody bets on the same pot, you may be right, but you're splitting that bet across so many other participants betting on the same pot as you. So the payout is naturally going to be higher where nobody else is really thinking can happen, which is basically just an argument for contrarianism, right? And back then, the sentiment was so dark, it's like you say to yourself, it can't possibly be that this is the end of the world. And if it is the end of the world, your money's worthless anyway. So you might as well take the bet, right? And I think this is what's missed the gloom and doom. I get it, right? I've played that game myself. You saying things like crash, correction, they get attention. Mm-hmm. But there's a difference between saying you have a crash or correction and then, saying here's the mile marker versus saying be careful, the conditions are there for the crash, or the conditions are there now for speeding up. Let's go back to the driving analogy. So you slow down, people are rubbernecking, they see an accident. Your ETA drops. Well, now after the accident, the road is free and clear. There's nobody there. You can go tremendously above the speed limit, right? Because everyone's already been slowed down by the bottleneck of the accident. So it's the same argument when it comes to investing. You want to always be humble in terms of thinking that guaranteed what's to come. You've got to be more objective, which is why I tell people all I do is give voice to math. And as a fiduciary running the ATAC rotation fund, the RORO ETF, risk on, risk off ETF, it's all quant-based. It's all based on indicators like lumber to gold to go risk on, risk off. It can be wrong a lot, but it's not forecasting. It's just slowing down automatically. But when it's right and it avoids the accident, that's how you can have 60 plus returns, 60 plus percentage returns, like I have this year in the mutual fund. It's something that I say frequently on my channel as well. It's not about predicting what's going to be taking place. It's about being prepared for what could potentially happen. And I think you kind of nailed it on the head there. When you're talking about your mutual fund RORO, what other information do you have for us on that specific that fund? How does that operate?
Sure. So I run two strategies. One is, and this is separate from the Lee Lag report. This is under Toronto, different entity, but I run the ATAC rotation mutual fund. Ticker on that is ATACX, ATACX. Uses utilities and treasuries to go risk on, risk off, can be in emerging markets. It's been around since 2012. Admittedly, I launched in the exact wrong time a mutual fund to be risk on, risk off in 2012 because When you have a risk on, risk off strategy in a pure risk on world, you're about as effective as a one-legged man in an ass kicking contest because you keep slowing down and by the way, let's kind of talk about that for a second. So when you talk about risk on, risk off, again, you're slowing down. Okay. In the context of markets, you can be slowing down quite a bit and being wrong quite a bit, right? So there are these two metrics in this business called up capture and down capture. So up capture is a metric that says what percentage of the market's upside when the market is up is your portfolio, is your strategy gathering. So if the market's up 10, you might be up 6. That means your up capture is 60%. Mm-hmm. And then down capture is what percentage of the market's negative returns are you capturing when the market's down? It's down 10%. Down capture is 60%. You're down 6. All right. So just a percentage. What percentage are you capturing? The problem with risk on and risk off is going to play risk off a lot. You're going to slow down a lot entering the storm, as was the case with my mutual fund and ETF RORO that I just launched. Your up capture is going to be meaningfully less than 100% because you're going to keep playing defense along the way. And again, you don't know which signal is the one where the risk off actually happens. All of the alpha, all of the outperformance, all of your real strength comes not from the upside, it comes from the down capture. So it goes back to this idea that if you want to really make big returns, you have to not focus on being up more, you have to focus more on being down less. But you cannot be down less unless you're also up less. You can't have it both ways. You can't be up more than the market and then be down less than the market over any sustained period of time. So everything I do, whether it's in the lead lag report, the mutual fund, the ETF RORO, which uses the lumber and gold signal, has some slight variations, but is purely rules-based, goes risk on into equities, risk off into treasuries. If your mindset is around down capture, you've got to be in a cycle where there's some downside to capture. Right, you need some volatility. And I think this is kind of also a very important nuance. Every investment, every sector, every asset class, everything has a cycle where it does better or worse. Risk on, risk off is no different. For risk on, risk off to work, you need to be in a cycle where there's more than just risk on. That doesn't mean a bear market. It just means you have to have swings. Now, I've made this point many times in my writings. I believe risk on, risk off is here to stay. And I believe it's here to stay not because I have an incentive to say that. I believe it's here to stay, risk on, risk off, because risk on, risk off is code for saying inflation or deflation. Because when you go back to the underlying award-winning white papers and all those signals that we talked about, under what conditions are utilities strong? Risk off. Are treasuries strong? Risk off. Is lumber to gold weak? Risk off. All that is a feeling of disinflation, deflation. Under what conditions are utilities weak? Treasuries weak. Lumber to gold strong. Risk on. It's when you have a feeling of reflationary hope. Okay. And given that we have so much debt and we couldn't pay off our debts before this, and God knows how bad it's going to look coming out of this, without being overly dramatic, I can make the case to you that the only question that mattered is not what hot IPO stock is coming out, what tech company is doing what. It's only one question that matters for every single investor out there: inflation or deflation. And because of that, I think you're going to have more of these swings between equities and treasuries, more of these swings in this risk on, risk off, which if you follow a systematic approach, it at least gives you a chance to not get sucked into the idea of, well, you must be out of your mind if you think markets are near the low when all you're doing is watching headlines as opposed to actual numbers.
The fact that you focus so much on the rotation portion, I need everyone to really understand just how important it is, because I talk about it so much about monitoring and managing risk, the downside potential of a market. And, your mutual fund, RORO, it does exactly that. The indicators that you use really help you determine that exact cycle, when you should get off, when you should get on. And most people that I've noticed, and it's just this euphoric time right now, everyone's just focused on capturing to the upside. But it seems like when you look at the NIM, when you look at the RIDEX, when you look at just various different sentiment indicators, everything looks just, and even breadth. Okay, so breadth of the market also just looks, when we look at like the S&P 500 percent of stocks over the 200 day, or the NDX, the percent of stocks over the 200, everything just seems jammed up to the most max extreme levels, which doesn't mean that it can't happen. But from a contrarian standpoint, it just seems like you need to be somewhat cautious, but it's also saying, hey, the time right now is risk on. And then you mentioned in March, you said, yeah, when things were lower, sentiment was extremely bearish. So maybe now from a contrarian point of view, maybe we got to start looking, hey, this could be the bottom. So from your point of view on, risk off, we are risk on, right? Is that the current signals right now?
Yeah, right now, I mean, everything is pointing there. But again, all this stuff is dynamic, right? That could change, obviously, in a moment's notice.
Right. Given the current of sentiment, the breadth, how are you reading that, or how are you interpreting that?
Well, it's. I don't disagree with a single thing you said, and candidly, I always have an incentive to want risk off. Right. I want risk off in general. I want to see volatility because I like to buy low. Right. I don't like to buy high, sell higher environment. I like to avoid the big declines when they inevitably happen as much as possible, and then load up, fully after the accidents occurred. Right. So, but there's a difference between sort of the thought process around an extreme and then having an objective process to identify the execution points to take advantage or not take advantage of those extremes, right? So, and I've always kind of used this example before, right? So Greenspan said irrational exuberance in 1996. Greenspan, former Federal Reserve chair, in 1996 said the stock market was going through a period of irrational exuberance. Well, he was right, but he was 4 years early, right? And that's why it's always tricky in this game of investing, because there's a fine line between being early and being wrong. Even if you go back to the housing crisis, right? Housing topped in 2006. You didn't have Lehman until 2008. A lot of people, as housing was starting to go down, were saying to the people who were saying this is going to cause a stock market crash that they're crazy. Nothing can stop this runaway train. Intermarket analysis. Housing was warning you in advance. It just didn't hit until 2 years later. So this is why I'm saying it's very tricky. That's why I tend to be much more of the mindset that it's better to be quantitative and objective in nature. Look at as many indicators as you can. Be ready, be prepared, scale out. Don't worry about FOMO, fear of missing out. Again, I go back to, if you want to kill it in the stock market, don't get killed, which means you have to be obsessed with risk. You have to be obsessed with risk.
For closing thoughts, kind of where we stand overall for the market, and maybe some advice that you can give somebody that is now recently or currently getting into investing, maybe, or that's been investing for quite some time. It seems like we're living in a state where people that save dollars become losers quite quick. And we live in an environment that's being encouraged to consume and put on more debt than other people can afford. So do you have any just maybe tips or advice for the average person that's trying to get into the stock market, but also might potentially have debt overhanging, some consumer debt, given this current environment? What would your advice be to that person?
Yeah, I mean, look, it's paying down debt is a better form of investment return than trying to gamble in the stock market. Just full stop, right? Because one is guaranteed, one is not. Guaranteed meaning if you pay down your debt, you're guaranteed to not pay off that interest rate because you no longer have that debt. You invest in the stock market, believe me, the returns that we saw this year are not guaranteed. No return guaranteed. I don't care. The sequence of returns often matters more than the actual trend of returns. Meaning, yeah, stocks may go for the long run, but it could be 5 years of nothingness, and then the sixth year you get a huge move. And meanwhile, your debt's eating away at you, right? So as a general rule of thumb, I think go for the guaranteed investment, which is not paying that interest rate in your debt. The other part of this from an investment standpoint, and I really am a big believer in this. Jeff Bezos once said, the key to success is to change your mind often, which basically is my way of saying never have conviction. Never believe too strongly in your investment thesis, in your investment ideas, in your research. There is always something that you're missing. And there's always some noise that will distort the signal and your comprehension on that signal. You have to be humble, because if you're not humble, and you have to have humility, because if you don't have humility, the market will force it on you at some point. Be systematic, and I always use this line. You've heard me say this before. No matter what strategy you follow, your ability to stick to a strategy matters more than the strategy itself. right? I don't care what diet you follow, you will lose weight as long as you stick to it. Anybody that's in this business of investing, whether you're new, old, amateur, pro, we all have the same dilemma, which is that emotions have a funny way of breaking down our analysis. Follow your strategy, be systematic, be ruthless in your thirst for knowledge, and don't get discouraged. Time's on people's sides.
First off, I want to just thank you for coming out here. Let's just go into just kind of how anybody can get a hold of you, where they can follow you, where they can see you. I'm going to make sure that I put all these links into the description below to your white papers and so forth.
Sure. So I mean, Twitter is kind of the best option at Lead Lag Report, and the service leadlagreport.com is available for anybody. I'm very clear that the audience for leadlagreport.com is not those looking for a hot stock. It just doesn't work, folks. You can say it works from here to tomorrow based on the small sample of the now. I'm talking from the experience of not just my life, but decades of research and data and award-winning white paper that's approved at that point. So, risk off matters more than risk on, full stop. So Twitter at Lead Lag Report, the service at leadlagreport.com. Intrigued by the lumber and gold research, you can see that research on ssrn.com, the Social Science Research Network. And again, the ETF, ticker RORO, risk on, risk off, is designed to basically take what I'm saying and do it in a rules-based vehicle through that exchange-traded fund. So I would love for the audience to take a look at that. It's not meant to be a product that you can think of in terms of beating the market. You have to view it as something that is different than the market. And in a world where diversification matters more than ever before, and it's so hard to get, I think that's worth something.
Well, Michael, I really appreciate you taking the time to come out here and talk with me and talk with the audience. It means a great deal to all of us. Spreading that knowledge around the FinTwit community has really been stepping up as of recently. So we really appreciate it.
No, I appreciate it. Thank you.